Okay. Good morning, all of you. So let's finish with this chapter today. Okay. We did. We completed the specific charge, section 45 1. Sorry, 45 1A, 45 2, and 45 5 yesterday. Okay. Now with 45 5, there is one exemption over here. Pay attention. In this exemption, which is given in 10 subsection 37, which says that if the assessee is an individual or HUF, he has transferred an urban agricultural land by way of compulsory acquisition. So transfer has taken place normally? No. The transfer has taken place by way of compulsory acquisition. So any capital gain arising on such compulsory acquisition of your urban agricultural land, if you are individual or HUF, whether the gain is short term or long term, will be fully, meaning there is no need to compute capital gain under section 45.5. On this compulsory acquisition, will you compute capital gain under section 45.5? The answer is no. Why? Because the capital gain is fully exempt, whether it is short term or long term. And what are the conditions for getting this exemption? The first condition is the urban agricultural land which is being compulsorily acquired must be used for what purpose? Agricultural purpose during the preceding 2 years immediately preceding to the date of compulsory acquisition, meaning this urban agricultural land was used by the assessee for the purpose of agriculture for at least 2 years immediately preceding to its compulsory acquisition, and the compensation for such compulsory acquisition was approved by central government or RBI, then this exemption will be available. Yes or no? So this was your section 1037. Next one, let's move on to section 46. Section 46, a company is in liquidation. Company is in, and at the time of liquidation, assets are transferred by the company to the shareholder. So when the assets are transferred? Normal time? No. The company which is in liquidation, that company is transferring the asset to shareholder, and the transfer of asset takes place on liquidation. So on this transfer, there is no consideration involved. Company does not get any consideration on transfer of these assets to the shareholder. Hence, this transfer is treated as exempt transfer as per section 46(1) in the hands of, meaning there will be no capital gain computed and taxable in the hands of company. Why? Because there is no consideration involved. The company is closing down, and at the time of closing down the company, whatever belongs to the shareholder is being given away to the shareholder. Yes or no? So if the company is in liquidation, transferring assets on liquidation to the shareholder, that transfer will be exempt transfer in the hands of the company. No need to compute capital gain, and it will not be taxable. But wait, if the capital assets are transferred by the company to any other person to raise money for liquidation, there is possibility that at the time of liquidation there are some outsiders to whom the money has to be paid. They are to be settled. Yes or no? So to give them the money, to settle them, the company is transferring the capital asset to outsiders. It is not a transfer on liquidation to the shareholder. It is a transfer by the company to outsiders, to other persons, to raise money so that the company gets enough money for liquidation. Getting my point? So in this case, the consideration flows to the company. Asset is transferred for a consideration to outsiders. Even if the transferring company is a liquidating company, yes or no, still the capital gain will arise. This transfer is not exempt under section 46, 1. Will you remember this? Yes or no? Now, see, 46, 1 was about company. It was talking about company. Now we are going to 46, 2. We are going to 46, 2. It is talking about shareholders. Now the company is in liquidation. You are a shareholder in that company. What that company is doing? The company is distributing you assets, or the company might also distribute cash. So when the liquidation happens, at the time of liquidation, this is an important part which I am discussing right now, because here you are supposed to see something for something from income from other sources also. Connectivity is there, yes or no? So pay attention on this part. See, the distribution will happen at the time of liquidation to the shareholder, and we are talking from the point of view of shareholder now. So become a shareholder. You are a shareholder in a company getting liquidated. So that company on liquidation, what that company is going to give you? Can the company give you assets? Yes. Take the fair market value of those assets as on the date of distribution, and whatever cash etc. will remain, that cash will also be given to the shareholder. So the company is being liquidated, all the outside liabilities are paid, everything is done. Now whatever will remain with the company, like assets, cash, everything will be handed over to the shareholder. You are the owners of the company, this all belongs to you. It will be distributed. So what all things can come to the shareholder? Simple. The shareholder can get the remaining assets as well as remaining cash. So you are a shareholder, okay? You are receiving what? Cash. And you are receiving assets. So you will have to take the fair market value as on the date of distribution. For example, you are getting cash of rupees 2 lakhs. Cash of rupees. And one asset you are getting whose fair market value is 8 lakhs. Fair market value is? So total how much? Can I say total 10 lakh worth of distribution happening by the company to the shareholder. Now this 10 lakh you are receiving from the company. For the company, the transfer of asset will be exempt under section 46, 1. But I am not talking about company anymore. I am talking about the shareholder. For you, how much is the inflow? 2 lakh rupees cash and 8 lakh worth of asset. 10 lakh is your inflow. 10 lakh is your, this inflow is happening at the time of liquidation. So to get this 10 lakh, what you will have to do? To get this 10 lakh, what you will have to do? You will have to surrender the shares. So you are a shareholder. Did you give away your shares? The moment you surrender your shares, what the company will do with these shares? Cancel. These shares will now be, shares will remain or shares will not remain anymore. Asset remains or asset does not remain anymore. Extinguishment of right in a capital asset. What was your capital asset, shareholder? Shares. Did you give it away? So you can say that it is relinquishment also. Yes or no? Did you give it away? You can say it is a relinquishment. But after giving those shares to the company back, the company is going to cancel. Meanings, shares, your capital asset will remain or it will not remain anymore? It will not remain anymore. There is an extinguishment of right in capital asset. Now, is it a transfer? The answer is yes. So what are you transferring, shareholder? What are you transferring? Shares. On transfer of shares, what are you getting? On transferring of shares, what are you getting? So based on this amount, your capital gain will be calculated. Based on this, now your capital gain of shares will be calculated. But wait. Out of this amount, no, some amount is already treated as your deemed dividend. Out of this entire 2 lakh plus 8 lakh, out of this 10 lakh, some amount will already be treated as your deemed dividend. To that extent, the amount should not be again taxed under the head capital gain. So eliminate that amount. And after eliminating that amount, which is already considered as your deemed dividend under the head IFOS, after eliminating that whatever remains out of that 10 lakh will be deemed to be the full value of consideration for transfer of your shares to the company. Yes or no? And on the basis of that amount, you are supposed to compute your capital gain and it will be taxable in your hands. That is section 46(2). Yes or no? So now how much amount will be treated as deemed dividend? How much amount will be treated as deemed dividend? To the extent of accumulated profits. What did I say? To the extent of accumulated profits as on the date of liquidation. So you have to check what was the date of liquidation. On that date, what was the accumulated profits, meaning reserves and surplus with the company. To that extent, whatever amount is given to you will not be treated as full value of consideration of your shares, because that amount is already considered as your deemed dividend. So for example, you are a shareholder. If the company gives you dividend, from where the company will give you dividend? Reserves. Yes or no? And if company already had what? Reserves as on the date of, if this reserves would have given when the company was a going concern, it was not under liquidation. If the same reserves were given to you, they were treated as your dividend. Then why not now? At the time of liquidation also, if the reserves are distributed, to the extent of that reserves distribution, the amount is treated as your dividend only. Yes or no? So to that extent, consider the amount under the head IFOS as your deemed dividend. So for example, the accumulated profits of the company as on the date of liquidation, the accumulated profits were, example, 4 lakhs. Example, how much? So out of 10 lakhs, 4 lakh rupees of reserves are distributed. Out of 10 lakh, 4 lakh rupees of reserves are distributed. So that 4 lakh rupees of distribution will be treated as your deemed dividend. Will be treated as your. So how much excess distribution happens? 6 lakh. That will be deemed to be the full value of consideration for transfer of shares in the, as such shares are surrendered by the shareholder in the event of liquidation, and on the basis of this amount you are now supposed to compute the capital gain. So capital gain would be computed and taxed in the hands of the shareholder under section for transfer of shares in liquidating company. Now what will be the period of holding of these shares? You are now supposed to compute the capital gain. So what was the total distribution? What was the accumulated profits of the company as on the date of liquidation? 4 lakh. So to the extent of 4 lakh, it was deemed dividend under IFOS. So how much is the excess amount? Will it be treated as full value of consideration? So full value of consideration you have 6 lakhs minus transfer expense. In our example, there is no transfer expense. Net consideration 6 lakh minus cost of acquisition of shares. So you will have to now see these shares which are getting transferred right now on liquidation, at how much cost you acquired it. So the cost of acquisition of those shares you are supposed to reduce to calculate the capital gains. Yes or no? But tell me, will that cost be indexed or without indexation? Depends on period of holding. So what will be the period of holding of these shares? It will start from date of allotment and ends on date of surrender, date of giving the shares to company? No, the date of liquidation. Because once the date of liquidation is announced, yes or no, after that only you are supposed to surrender the shares. After that only you are supposed to give the shares back to the company. So you are going to give the shares before, or you are going to give the shares after the date of liquidation. And as on the date of liquidation, the company ceases to exist. If the company is no more in existence, the shares are not in existence. Yes or no? So when the life of the shares, when the period of shares should end, should it end on giving the shares back to the company, or it should end on date of liquidation? Date of liquidation. Any period after the date of liquidation. Any period after the date of will not be included in the period of holding of these shares. The period of holding of these shares will be up to date of liquidation. Will you remember this? Okay. So you will start the period of holding from and end the period of holding on. Now you will have to check this period of holding. You will have to check the period of holding up to 24 months. If the shares are unlisted, so you will have to check up to 24 months. Short term. You know the cost of shares? Yes. Without indexation. Yes or no? But what if the period is more than 24 months? Shares are? So, indexation will happen or not? Depends on the date of transfer, meaning date of. So, if the date of liquidation is prior to 23rd July and the shares are held for more than 24 months, you will do the indexation also. Yes or no? But if the date of liquidation is on or after 23rd July, then and the shares are held for long term, yes or no, more than 24 months, then even if the shares are held for more than 24 months, indexation benefit will not be available because the liquidation takes place on or after 23rd July. Getting my point, everyone? Now, if the shares are short term, cost of acquisition of shares with indexation or no indexation? If based on this period of holding, shares are long term, so the cost of acquisition of the shares will be index if the liquidation takes place prior to 23rd July. And the cost of acquisition of the shares will not be index. Even if the shares are long term, it will not be index if the liquidation takes place on or after. Now, if you want to take the liquidation, since the if you want to take the indexation, the liquidation takes place prior to, only then you are going to do the indexation. Now, how will you do the indexation? You will take the cost of acquisition of the shares multiplied by year of transfer, CII of year of. So, what is the year of transfer? Year of liquidation is the year of transfer. CII of that year you are going to multiply, divide by CII of year of acquisition of your shares. Yes or no? Like this, you are going to index the cost. If it is to be indexed, it will be indexed like this. Will you remember? Hello, sir. Now, think one step ahead. Tell me what you were getting here. 2 lakh rupees of cash. And you were getting one assets. What was the fair market value of the asset? Now tell me, this entire 10 lakhs, this includes the value of the asset. Includes the value of the asset. Now out of this 10 lakhs, some amount is already getting taxed under the head IFOS as your deemed dividend. And out of that 10 lakhs, some amount is getting taxed under the head. So can I say, out of 2 lakhs, some amount is getting taxed here and some amount is getting taxed here as capital gain. Out of 8 lakh also, some amount is getting taxed as your deemed dividend and some amount is getting taxed under the head capital. Can I say the entire fair market value of the asset, 8 lakh, is getting taxed? Is getting taxed as your income. Some part of that under the head IFOS, some part of that under the head capital gains. Understood now? Now the same asset which came to you on liquidation, the same asset which came to you on, you are transferring that asset. Will you calculate capital gain at that time? In future, now what are you transferring? This asset which you received on liquidation. Will you compute capital gain at that time? Yes, this is your capital asset now. Now this is your capital asset. On liquidation, the company gave it to you. What was the fair market value? That already became your income and already taxed in your hands. Yes or no? Now the same asset if you transfer in future, will you compute capital gain at that time? So for example, this asset was transferred in future for 12 lakhs. How much? So what will be the full value of consideration? 12 lakhs minus transfer expense. For example, no transfer expense. Net consideration will be, what will be the cost of acquisition of this asset. The fair market value of rupees 8 lakh will be deemed to be the cost of acquisition of these assets which you received on liquidation. Why? Because that 8 lakh is already considered as your income and you have already paid tax on that 8 lakh. So now somebody will say, sir, but I did not do anything to get this asset. I got the asset free of cost. Did you pay anything to the company to get the asset? So actual cost was nil. You did not pay anything to the company to get this asset. And if you take nil as your cost of acquisition, so how much capital gain will be taxable? 12 lakh minus nil, full 12 lakh will be taxable. Meaning this 8 lakh which has already suffered tax right now will be again taxed for the second time when this asset will be transferred. If you will take the cost as what? Nil. You want to pay tax for the second time on this 8 lakhs? Do you want to pay tax for the second time on this 8 lakhs? No, na. Take this 8 lakh only as the cost of these assets whenever you will transfer them in future. Yes or no? And what will be the period of holding of these assets? From which date you start holding these assets? From the, no, not from the date of liquidation. The company distributed the asset. From that day onwards, you start holding the assets. Yes or no? So from the date of distribution, you started holding this asset till the date of transfer. And if that period is short term, then no indexation. Cost is 8 lakh. The fair market value will be deemed to be cost of these assets. Yes or no? And now you will check the period of holding of the assets. What is happening? Are you able to visualize what I am trying to tell you all? Or just sitting and listening? Let him speak. Let he finish the things. We are not bothered. Are you understanding what I am trying to explain? So first point tell me, company is in? On liquidation, the company is transferring to its, what will be the tax treatment in the hands of company? The transfer is exempt transfer. There will be no capital gain computed and taxable in the hands of company. Now think about shareholder. What the shareholder is getting? Assets. Only assets he will get, or he can also get cash. So on liquidation, the shareholder is receiving cash as well as asset. Cash of 2 lakhs. Assets fair market value is? Fair market value has to be taken as on the date of? As on the date of. So the date on which the assets are distributed. The date on which the assets are. What is the fair market value as on that date? Yes or no? Now 10 lakh rupees of distribution is taking place. Out of this 10 lakh, some amount will already be treated as your deemed dividend under the head IFRS 222C. 222. How much amount will be treated as deemed dividend over there? No. Amount to the extent of accumulated profits as on the date of? As on the date of? So as on the date of liquidation, whatever was the accumulated profits of the company, to that extent, the amount will be treated as deemed dividend out of total distribution. Total distribution was? And out of that 4 lakh is treated as? So how much is remaining? Now this 6 lakh will be deemed to be the full value of consideration of shares in the hands of shareholder, which the shareholder is going to transfer to the company. So on transferring of the shares by the shareholder to the company on liquidation, capital gain will be computed, and to compute that capital gain, entire 10 lakh will not be treated as full value of consideration, only 6 lakh. 6 lakh minus transfer expense, net consideration. What will be the cost of acquisition of these shares? The shares were acquired long back. At what cost? That amount of cost you are going to reduce. Yes or no? Hello. With indexation, without indexation? Depends on the period of holding of shares. Period of holding of shares will start from date of allotment of the shares till date of liquidation. Period after the date of liquidation will not be included, will not be considered in the period of holding of shares. Yes or no? Now, this period of holding, based on this, the shares are short term. Cost of acquisition of the shares without indexation. Yes or no? Based on this period of holding, if the shares are long term, cost of acquisition of the shares with indexation, without indexation, depends that when the liquidation took place. Liquidation took place prior to, then indexation. Liquidation took place on or after 23rd July, then no indexation. Yes or no? And this will give you the capital gains which has to be taxable as per 46(2) in the hands of shareholder. Here the discussion is over. But now we are thinking one step ahead. Now everything got over. You are a shareholder. What are you having in your hands now? You are having cash also and you are having asset. Forget about the cash. Talk about the asset. Did you go in the market and buy this asset? Or you got this asset on liquidation from the company? You got this asset on liquidation of the, what was the fair market value of the asset? So this 8 lakh was taxed some amount under the head IFOS as your deemed dividend and some amount under the head capital gain as your full value of consideration. Yes or no? Entire 8 lakh is taxed. So whenever this asset you will transfer in future, whenever you will transfer this asset in, what will be the cost of acquisition of these assets? 8 lakh, the fair market value, which was already considered to compute 46(2) and your deemed dividend amount. Yes or no? That entire 8 lakh will be deemed to be your cost of acquisition. 8 lakh will be deemed to be your cost of acquisition of these assets. Now what will be the period of holding of these assets? The period of holding of these assets will start from date of distribution, date on which the asset was distributed to you. Yes or no? And it will end on, and based on this period of holding, if you know that the asset is short term, you know the cost, how much? Without indexation. Yes or no? And if based on this period of holding you know that the asset is long term, you know the cost, 8 lakh with indexation or maybe without indexation, depends then when the asset was transferred. If the asset was transferred prior to 23rd July, no need to index the cost. Yes, sorry, you will index the cost. And if the asset was transferred on or after 23rd July, you will not index the cost. Will you remember this? Sure. Section 46 over. Section 46 over. Now let's come to, and now there is one amendment over here, very important, connected with IFOS head. Connected with IFOS head. Okay. Now see, if a domestic company is there, the company is buying back its own from the, did I write securities or I have written shares? Shares can be equity or shares can be listed or it can be any type of shares. Now you are a shareholder. Assume that you are a, and these shares are held by you. You bought these shares. The shareholder, for example, shareholder acquired these shares on in 2018-19. So in 2018-19 you acquired these shares. Remember the date. Remember the year. When did you acquire? 18-19. And the cost of acquisition of the shares was, let's say cost of acquisition was 2 lakhs. Cost of acquisition was done, sir. So in 18-19 you acquired the shares. What was the cost? Okay. So now you are a shareholder. Now the company is coming to you in 24-25 and the company is doing a buyback. Company is offering higher amount. What is the value of the shares in the market? Value of the shares in the market today, 2 lakh was the cost in 18-19. Hello. What is the value of the shares in the market today? Example, it is 4 lakhs. It is? So definitely the value has increased. Now the company is coming and telling you, give me my shares back. So company wants to buy these shares back from you. Yes or no? So company is saying, shareholder, give us the shares back. We want to buy your shares. Will you give it back to the company. If it is profitable, why not? So the company is saying, what is the value of the shares in the market today? Take this 4 lakhs and give the shares back. Will you give? Why? Why would I give you? If in market, if I can sell it to anyone and I can get 4 lakh from the market, why would I give it back to you? No. Company will say, take 4 lakh 20. We will be little interested. 4 lakh 20, more than market price. Company will say, no, 4 lakh 20 no. Very soon it is going to become 420 also. Company will say, take 4 lakh 50. No. Company will say, take 5 lakh rupees right now. Now it is a very good amount. Now you will become what? Greedy. Yes or no? What you will do? Take the shares back. Why? Because anyways the company is offering you a higher amount as compared to the current market price. What is the higher amount? 5 lakhs. So can I say you gave away your shares? Sir, you gave away your shares? Shares are transferred because here the relinquishment happens. Extinguishment of right in a capital asset will take place. Yes or no? So the shares are transferred. Shares are. And how much you received? 5 lakh. So how much should be your gain? 5 lakh minus 2 lakh. 3 lakh should be your gain. On that 3 lakh you should pay tax. On that 3 lakh you should pay. But wait. That 3 lakh will be taxable as your capital gain under section 46A by taking buyback price as your full value of consideration minus the cost of shares 2 lakhs. Yes or no? That 3 lakh will be taxable as your capital gain under section 46A. Usually this should happen. Usually. And this happens in the case of every company transferring doing the buyback of any shares, any securities. This happens in the case of every company doing the buyback of either shares or securities from the shareholder. But there is one exception. There is one. And that exception I am telling you first. That if the company is and the company is doing buyback of from the shares can be now on buyback the shares will be given even if it is a transfer by the shareholder. Still 46A capital gain will not be calculated in the hands of shareholder because the entire buyback price coming to the shareholder is fully exempt. Because it is fully exempt. How much buyback price coming to the shareholder? 5 lakh. That 5 lakh will be fully exempt in the hands of shareholder. Sir, why that 5 lakh will be fully exempt, sir? It is a consideration for transferring the shares. So it should be taxable, no? In the hands of shareholder as full value of consideration. It will not be taken as your full value of consideration. It will be fully exempt. That entire 5 lakh will be exempt in the hands of the shareholder. And the reason is, there is one section, 115 QA. Which section? As per section 115 QA, the company is liable to pay tax on that buyback price. So company pays its own income tax. Company will earn income. On that income, the company is going to pay its own income tax. Along with that, the company has to pay additional tax on your income, which you are earning as buyback price. So what is your income? Buyback price. On that income, you are not liable to pay tax. There is one section 115 QA. As per section 115 QA, on that the company is liable to pay income tax. Since your income on that whatever tax was there was already paid by the company, should it be again taxed in your hands? Hence that buyback price fully exempt under section 1034A. Which section? So 1034A will be applicable to the, and entire buyback price will be fully exempt. Entire buyback price will be fully exempt. Why it is fully exempt? Because the company, for company which section is applicable? 115 QA, and as per this section, the company is already paying tax on this buyback price. How much tax the company has to pay? 20% plus 12% surcharge plus 4% cess. So 20 plus 12% will be 2.4. 22.4 and 4% of that. So in all it is 23.296%. How much? So that entire buyback price in the hands of domestic company will be taxable at what rate? And since the company has already paid tax on this buyback price of 5 lakh rupees, yes or no? Will this be treated as full value of consideration again to compute your capital gain under section 46A? No. So this will be fully exempt under section 1034A in the hands of shareholder. Hence 46A, capital gain computed or not to be computed? So what is happening? See, buyback of what? Buyback of by domestic company from its shareholders. Yes or no? Now on this buyback, you have to think from the point of view of both. From the point of view of the domestic company and from the point of view of shareholder. Yes or no? Now see, whenever buyback happens, section 46A comes into picture. Which section? Which says that any type of company doing buyback of any shares or securities, yes or no? At the time of buyback, whatever buyback price is given by that company, on the basis of that buyback price, the capital gain needs to be computed in the hands of shareholder or security holder. Yes or no? On the basis of that buyback price, capital gain will be computed in the hands of shareholder or security. Any company, what did I say? Doing buyback, doing of its shares or securities. At that time, capital gain will arise in the hands of shareholder or the security holder. Capital gain will arise in the hands of shareholder or security holder because he is transferring his shares or securities on buyback to the company. So to calculate that capital gain under section 46A, the buyback price is to be taken as full value of consideration. This is section 46A. This is section 46. You are going to apply these provisions every time. But there is one exception. There is one. In this exceptional case, 46A will not be applicable. Capital gain will not be calculated. And what is that exception? A domestic company doing buyback of shares from its shareholder. So at that time, in the hands of shareholder, capital gain under section 46A will be computed or will not be computed? Will not be computed. Why? Why? Because on this buyback, whatever buyback price is received by the shareholder, that buyback price is what? Fully exempt under section 1034A. If this is fully exempt, no need to take it as your full value of consideration and no need to calculate your capital gain. We will forget about the buyback price. You forget about your cost because you incurred 2 lakh rupees of cost and earned 5 lakh rupees of income. There was 3 lakh rupees of gain which we will not tax you. Why, sir? Simple. The company has already paid tax on the entire buyback price. The company has paid tax on the entire. So what the domestic company will do under section 115 QA, that is applicable, and what the company is going to do, the buyback price is what? Taxable, sorry, on the buyback price, tax at the rate of 23.296% will be paid by the company. So on the entire 5 lakh rupees of buyback price, for example, if the buyback price was 5 lakhs, on the entire 5 lakh rupees of buyback price, the company has paid tax. So shareholder, ignore 5 lakhs. Don't take it as full value of consideration to calculate 46A capital gain. We will forget 5 lakh, you forget 2 lakh rupees of your cost. What was the cost of your shares? 2018-19, cost of shares was 2 lakhs. You forget about the cost. We'll forget about the full value of consideration. No need to calculate the capital gains under section 46. Did you understand this entire part? Any doubt, difficulty? Sure? Hello? Sure, no? This provision was applicable up to 30th September 2024. If the buyback takes place up to 30th September, then these effects are to be given. Then these effects are to be given. Now, with effect from, what did I say? With effect from 1st October 2000. What is the effect, you know? What is the effect? For domestic company. For and for shareholder. For domestic company, 115 QA will not be applicable. Will not be. So that entire buyback price of 5 lakh on which the company used to pay tax. Will this buyback price be taxable at the rate of 23.296% anymore, or it will not be taxable? 115 QA not applicable. So now the buyback price is not taxable in the hands of domestic company. Hello sir. But wait, if the company has not paid tax on this, now who should pay tax? Last time company was paying tax, so we spared you. We gave the exemption of buyback price under section 1034A. Now tell me, for the shareholder, for the exemption which was available for buyback price under section 1034A, will it be available or it will not be available? It will not be available. So now the capital gain under section 46A, capital gain under section 46A needs to be computed in the hands of shareholder. Now here, what will be the full value of consideration? What will be the full value of consideration? Buyback price minus cost of acquisition. What was your cost of acquisition? 2 lakhs. That you are going to reduce here. Yes or no? And the resulting amount will be taxable as? Resulting amount will be taxable as? Now see, what will be the amount of capital gains? 3 lakhs. Yes or no? Now tell me one thing. This capital gain will be covered under which section? If it is long term, it will be covered under 112. Covered under, and the shareholder will have to pay how much tax? 20%. That bloody anyways we were getting from the company. Company was anyways paying the tax at the rate of 20%. Now we are saying, no, company you don't pay. We will charge the amount in the hands of shareholder and let the shareholder pay the tax. So shareholder computed the capital gain under section 46A. That 5 lakhs which was not taxed in the hands of company, now that 5 lakh will be taxable in the hands of Shareholder, and shareholder will be calculating what? Capital gain under section by taking that 5 lakh as full value of consideration. And the gain out of that 5 lakh, whatever gain will remain, if that gain happens to be long-term gain, at the most on this gain, the government will get how much tax? 20%. Anyways, the government was getting 20% from the shareholder. So what is the benefit? What is the benefit by charging this amount in the hands of shareholder if we are getting the same amount of tax? Hello? So no. We don't want 20% tax on this amount. We want higher tax. We want higher tax. Because the company was already paying 20% plus 12% plus 4%, 23.296% the company was already giving the tax on this buyback price. And if we are getting the same amount of tax by charging this amount in the hands of shareholder, no need to amend, no need to do any change. But still we are changing. So now we want higher tax from the shareholder. Higher tax from the, which is possible only if this buyback price is not taken under the head capital gains. Only if this buyback price is not taken under the head. If we take this buyback price as full value of consideration under the head capital gain, ultimately the shareholder is going to pay 20% of tax on that. So remove this buyback price from capital gain. This entire buyback price, what did I say? Entire buyback price received by the shareholder will now be treated as deemed dividend under section 222F under the head IFOS in the hands of entire buyback price of 5 lakhs will now be taxable as deemed dividend. Just see the things which the government is doing. This should have been your full value of consideration for transferring the shares. Yes or no? This should have been the full value of consideration to calculate your capital gain under the head. But no, if we'll consider it there, then the tax will be only 20%, maximum 20% we will get. So ignore that buyback price from capital gain, bring that buyback price under the head IFOS. Under section 222F, we will consider this amount as deemed dividend for whom? Shareholder. Now tell me, which type of income this is? Other source, special income or a normal income? Under the head IFOS, all incomes are normal incomes, taxable at normal rates, until and unless it is winnings or unexplained income. Yes or no? Winnings or unexplained incomes are taxable at special rates. But all the other incomes under the head IFOS will be taxable at normal rates, including your dividends. Yes or no? So, how much tax you are supposed to pay on your normal incomes? Normal rates, which are given in slab. First 2,50,000, no tax. 2,50,000 to 5 lakh, 5%. 5 lakh to 20%. Above 10 lakhs, at least we will be able to charge 30% on that buyback price which is over and above 10 lakhs. There we'll get 10% more tax. Getting my point? Hence, it is better to charge buyback price under the head. And now you will again charge this buyback price under capital gains. So under the head capital gains, don't take the buyback price. Hello? Take your full value of consideration as nil. 46A capital gain will be calculated here. Because the amount was not taxed in the hands of company. So definitely the shareholder has to calculate capital gains. Yes or no? But to calculate that capital gain, whatever buyback price was supposed to be taken as full value of consideration, that is already taxed under the head IFOS as what? Deemed dividend. Now that same buyback price cannot be again taxed under the head capital gain. What are you going to do? Take it nil. Take the buyback price as nil. Take the full value of consideration as nil and compute your capital gains, which will not be capital gains. It will always be capital. How much loss will come here? How much loss will come here? And how much income got taxed? 5 lakhs. 5 and negative 2. Net effect of 3 lakhs. And anyways, you would have paid tax on 3 lakhs if the buyback price would have been taxed there. Getting my point? But that 3 lakh would have been taxed in the form of capital gains at what rate? 20%. But here the entire 5 lakh will be taxable at normal rates. Yes or no? At normal rates. And that 2 lakh which was the cost of your shares, we will allow that cost under the head capital gain. Calculate the capital gains under section 46A by taking that 2 lakh as a deduction. But don't take the buyback price again as full value of consideration over there because it is already charged. So what you will take as full value of consideration? Nil. What you will take full value of consideration? So nil minus 2 lakh will give you gain or it will give you? Now 46A will give you loss. Loss amounting to? Now this will be your normal loss or long-term loss, short-term loss? This will be short-term loss or long-term loss, yes or no? This will be set off only against capital gains and restricted carry forward for 8 years. Getting my point? If you have any capital gains, from that capital gains you can set off this loss. But the 5 lakh rupees of entire income we are going to charge under IFRS now. Did you understand? This is very important adjustment, amendment. Okay. Expect one question on this in your examination. Now tell me, I'll keep on asking you. You are now supposed to answer. Okay. First, I am a company. You are a shareholder. Which type of company? Domestic company. And you are a shareholder. Okay. You bought the shares for 2 lakhs long back. Now today the buyback is taking place. Buyback is taking place today. I am offering 5 lakh rupees as buyback price. How much? So is it a consideration for transferring your shares? Yes, it is a consideration for transferring your shares. Based on this, your capital gain should have been computed. But this buyback price is fully exempt under section 1034A. 1034. Why? Because on this buyback price, the company will give tax under section 115 QA. So no need to compute the capital gains by the shareholder. 46A will not come only. 46A will not come only. We forget the buyback price, you forget the cost. No need to compute capital gain under 46A because the company has already paid tax under section 115 QA. This will happen. These tax treatments will be given up to if the buyback takes place on 30th September or prior to that. This effect you are supposed to give. But what if the buyback takes place on or after 1st October 2024? Now the effects will change. For company 115 QA, applicable, not applicable? Will the company pay tax on this buyback price? So definitely for shareholder, the buyback price will be exempt under 1034A or not exempt. So for the shareholder, exemption is gone. Now this buyback price has to be taxed in the hands of shareholder because now the capital gain will be calculated under section 46A. So this buyback price should have been treated as your full value of consideration minus the cost of your shares. Yes or no? But this entire buyback price you are not going to consider as full value of consideration. Entire buyback price will be treated as your deemed dividend under section 222F under the head IFRS. So did you take this entire 5 lakhs under the head IFOS? So now will you take this 5 lakh again as full value of consideration to calculate your capital gains? Your capital gain will still be computed under section 46A, but your full value of consideration will be nil. Full value of consideration will be, and you will reduce the cost. You will reduce the cost. What was the cost? And it will result into loss. Calculated as per 46A, it will result into loss. Whether the, see, if the shares were short term, then the loss will be short term capital loss. And if the shares were long term, then long term capital loss. This loss will be adjusted only against capital gains. But the entire 5 lakh will be taxable under the head IFOS as your normal income, yes or no? And it might get taxed at higher rates if it exceeds 10 lakhs. Earlier, no, if you were receiving a buyback price of 5 lakhs or buyback price of 50 lakhs, the government used to get only 20% tax on that entire buyback price. Now government thought that someone is earning buyback price of 50 lakhs and still on that 50 lakh rupees of buyback price we are getting how much tax? Only 20%. But if this amount would have been taxed at normal rates, up to 10 lakh we would have got no tax, 5%, 20%. But over and above 10 lakh, on that 40 lakh we would have got 30%. No. So to do that, this amendment has come. This is very bad. This should not be done, but you cannot help out. Ultimately, it is the choice of government. Will you remember this? Sure, everyone. Now see, now what I am writing. What did I do? Wait, before any company I'll write which company? Now, he is shareholder or security holder? Shareholder is a different person and security holder will be a shareholder will hold and security holders will hold like bonds, debentures, etc. Securities other than shares. Securities other than. So now from this security holder, what will be bought back? Securities like bonds, debentures, etc. are bought back. This domestic company is not liable to pay tax on this buyback price. 115 QA does not apply here. Yes or no? Hence the security holder will not get any exemption. So for security holder, 46A will be applicable. 46A will be, this buyback price will be treated as full value of consideration and minus cost of acquisition of what? Securities. Based on that the capital gain will be computed. Will you remember? Hello? Prior to 30th September, prior to 1st October also the situation was same. On or after 1st October the situation is same. There is no change. Will you remember? Now any company which is not a domestic company, now he is a shareholder or security holder. Yes or no? Now what he will transfer? He will transfer shares or he will transfer securities. Buyback is happening. Yes or no? On this buyback also the company is not liable to pay tax. 115 QA not applicable. Accordingly, the buyback price is also not exempt in the hands of shareholder. So here also capital gain will be computed under section and this buyback price will be treated as full value of consideration minus cost of acquisition of shares or securities will give you the amount of capital gain, and that capital gain will be taxable in the hands of shareholder or security holder. Prior to 1st October also the situation was same. On or after 1st October also the situation is same. No change here. Got it, sir? Hello, sir. You understood a concept which usually the students at final level also don't understand. You understood it quickly. Yes or no? Say thank you. Mention not, mention not. Finance Act 2024 amendment with effect from this and this. Entire thing I have discussed. This part also I have just now discussed. Okay. And this part also I have discussed. Now, second part of the chapter is over. What was the second part? First part was basics. That we completed. Second part was that also we completed. Now we are coming in the third part of the chapter, special aspect. In certain special situations, how to calculate capital gains. In certain special situations, how to compute. Which is the first section you can see? Section 50. Can you see this? Is it visible, guys? The students who are sitting in the last bench, can you see that? Read it. You know this. I've already taught you under the head PGVP, depreciable assets. Capital asset, depreciable asset is a capital. The assets which are used in your business or profession, yes or no? Are all depreciable assets, no? The cost of those assets are allowed under the head PGVP in the form of depreciation, but those assets are your capital assets or not? Depreciable assets are capital assets which are used for the purpose of your business or profession. Forming part of block. Forming part of. Some depreciable assets are there which does not form part of block. If your business is power business. So for each asset you charge, you calculate depreciation separately on the actual cost and you claim that depreciation on SLM basis. Do you remember? And at that time, when we did PGBP, at that time I have already told you that capital asset, even that asset is also a capital asset. But that asset is not under the block. That asset is not under the block. Although that asset is a depreciable asset. On that you claim the depreciation, but is it a part of the block? No. So I'm not talking about those assets. I'm talking about which assets? Those assets which are depreciable asset, but which are forming part of. Now if these assets are sold, transferred, damaged or destroyed, compulsory acquisition takes place. Capital asset, sold. Capital asset, damaged or destroyed. Capital asset, damaged or destroyed, insurance claim received. Capital asset, compulsorily acquired. Claim received, yes or no? If this type of capital asset is transferred, no need to bring that money and the asset under the head. Entire adjustment you do in the value of the block as deletion, because the asset will go out of your business from the block. So whatever amount will come on the asset going out, that entire amount will be adjusted from the value of the block. Asset is sold, selling price is received. Deletion, reduce the selling price. Hello? Asset is damaged or destroyed. Insurance claim is received. Deletion. Reduce that insurance claim amount from the value of the block. Asset is compulsorily acquired. Asset is deletion. And reduce the amount of compensation from the value of block. All the adjustments will happen in the block. Yes or no? And after doing this adjustment, if the value also remains in the block and assets also remain in the block, what you do? You still claim the balance amount of cost under the head PGBP only in the form of depreciation. But you will come to capital gains head. You will come to under section. If there is a value still remaining in the block, but no assets remaining in the block, it will be treated as your short-term capital loss. Assets are not remaining and there is value in the block. Yes or no? That value will be your short-term capital. Assets are remaining. Assets are remaining. Value does not remain, meaning you have recovered some extra amount. Short-term capital gain, I have already discussed. Block does not cease to exist. Block cease to exist when you will calculate depreciation, when it will be short-term gain, when it will be short-term loss. With numbers we have done this thing with depreciation. Okay, so I'm not going to discuss this, but remember one thing: whenever you are coming in section 50, whenever the gain or loss you will bring under capital gain, the nature of that gain or loss will always be short term. No need to check any period of holding. Why? Because the moment the asset goes in the block, its identity is gone. And the asset whose identity is not there, we don't check any period of holding for those assets. So no need to check the period of holding also. Hello? And the entire gain will always be treated as short term. Entire loss will always be treated as short term. Will you remember? So this was section 5050. 50A. What is this? You also know. Sorry. Okay, I have written wrong. Huh? You also know this. You know this, but you also know this. Do you remember depreciable asset on which depreciation is claimed under section 32(1)(1) on? We used to calculate terminal depreciation. We calculated balancing charge also. 4 cases I told you. What was the cost of the asset? 100. Out of that, in 4 years, you took 10 lakh, 10 lakh, 10 lakh, 10 lakh as depreciation. 40 lakh depreciation you have already taken. So what is the value of the asset remaining? This is the remaining cost. Hello? Against that, you are selling this asset now. You are selling this asset for 4 possibilities. 42 lakhs, 60 lakhs, 85 lakhs and 102 lakhs. Here, terminal depreciation. Here, no tax effect. Here, amount received in excess of WDV amounting to 25 lakhs, balancing charge. And here, up to 40 lakhs. Up to 40 lakhs, it was your balancing charge, deemed PGBP, yes or no? 2 lakh extra. Capital as per 50A. You already know this, yes or no? Let's move on. Let's move on. See that entire thing again I have given here. That entire example I have again written here, okay? Now this is an important section, 50AA, because there is an amendment in this section in this year. See, this section came in the last year. There was an amendment and in the last year this section came. Last year only 2 assets were covered. Last year only. Now this year one more asset is added in the list. So what this section used to say, that if there are market linked debentures or units of specified mutual fund acquired on or after See, market linked debentures can be acquired at any time. Market linked debentures are acquired anytime. But if you are talking about units of specified mutual fund. And what is the specified mutual fund? Debt oriented mutual fund. Which mutual fund? Debt oriented mutual fund means the mutual fund taking money from the investors, unit holders, and 65% or more amount is investing in debt securities. That is debt oriented mutual fund. Yes or no? So I am a mutual fund. I am taking money from you. So you all are investors. You are the unit holders. So you will invest money and I will issue units to you. You will invest money in the mutual fund and the mutual fund will issue units. So the units are given. Now the units which are held by you for this mutual fund will be treated as units of debt oriented mutual fund if this mutual fund taking money from the investors and 65% or more money the mutual fund is investing in debt securities. Then the mutual fund is debt oriented. And there is equity oriented also. Hello? What is equity oriented mutual fund? You invest money in the mutual fund, 65% or more amount of your investment, the mutual fund will invest in equity shares of domestic company. Yes or no? So we are talking about which mutual fund? Specified mutual fund. And which mutual fund is specified? Debt oriented. Which mutual fund is specified? So units of debt oriented mutual fund, which you have acquired on or after? On or after? Very good. And one more asset is added. That asset is unlisted bonds or debentures which are transferred, which are on or after. Now these unlisted bonds or debentures you have acquired at any time. You might have acquired the unlisted bonds at any time, unlisted debentures at any time. But their transfer, if it takes place on or after 23rd July, then for these type of assets also section 50 AA will be applicable. Now, what is the common thing in three assets, you tell me? Common thing is debt. Common thing is, and debt does not, there is no increase in the value of debt due to inflation. Inflation does not affect your debt, or does it? No, it affects the interest rates, but it does not affect your debt. For example, 10 lakh rupees you have taken a loan from me today. What will be the value of that loan after 10 years? 10 lakhs only. I owe you 10 lakhs only. Hello? So inflation is not going to affect the value of that debt. Market linked debentures, debt only. Hello? But the returns are market linked. Returns are, meaning the rate of interest keeps on changing. Rate of interest keeps on changing. That rate is not dependent. It is not fixed. That rate depends on some other security. If the other security or the other asset is giving you a rate of 20%, and on that, if the rate is dependent, then the rate of market, other securities in the market, or the index on the basis of which the rate is fixed, if that rate fluctuates, this rate will also fluctuate. Only the interest rate is dependent on market, but ultimately the underlying asset is debt only. Invest how much? 10 lakhs. Invest 10 lakhs in market linked debentures. These are usually what? Listed. Okay. But the returns you are going to get in the form of interest, those returns will not be same. Those returns will be dependent on returns of some other index or return of some other security. And because of that, there will be a slight change in the value of these market linked debentures. From 10 lakh it will become 10 lakh 10,000. From 10 lakh it will become 10 lakh 20,000. Why? It is not because of change in the value of underlying asset debt. No, it is because of change in the market rate. based on which the returns are dependent. Now tell me, if the returns from this debenture keeps on increasing, the people will demand it more. Hello. So slightly its value is going to go up. If the rates are coming down, so its demand will come down. So the value will slightly change. So there is a change in the value of these market linked debentures, but that change is not because of inflation, because the underlying asset is not an asset which is affected by inflation. The underlying asset is debt only. These units, they derive their value from the debt, because the units are of debt oriented mutual fund investing your money, 65% or more money in debt securities, and based on the investment in the debt securities, the value of these units is derived. So the units which you have bought are deriving their value from debt security. So ultimately the underlying asset is what? Debt. Here also, what is this? Unlisted, or they are also debt. Now if the debt does not change over a period of time, inflation does not affect, what the assessee is used to do? Assessee is used to determine their period of holding. If less than 36 months, for these 36 months period of holding was earlier checked. For unlisted bonds or debentures, what used to be the period of holding? 36 months prior to 23rd July. If period of holding is 36 months or less, then short term. Indexation will be available? No. What if the period was more than 36 months? Long term. Indexation will be available? No. For any bond, any debenture, indexation benefit was not available. It was available only for two assets, two types of bonds: capital indexed bonds and sovereign gold bonds. So first thing you have to keep in your mind, that whenever you have any bonds or debentures, whenever you have any underlying asset is a debt, and debt does not change over a period of time due to inflation. So there is no effect of inflation. The 10 lakh rupees of debt which I have given right now will be worth 10 lakh after 5 years also, after 10 years also. Getting my point? So if I have debenture, if I have bonds, whether listed or unlisted, getting my point? So that time what used to happen? I'll write down here so that you get a consolidation also. See, if the bonds or debentures, there are two types of bonds or debentures. Come on, tell me, bonds or debentures. One is listed and the second one is unlisted. Okay. Now pay attention, listed or unlisted. Now if the bonds or debentures are listed and they are transferred prior to 23rd July 2024, or they are transferred on or after 23rd July 2024. Now see, their period of holding for listed bonds or debentures, what used to be the period of holding? 12 months. Earlier also 12 months, and now also. Listed bonds, listed debentures are nothing but listed securities. Yes or no? So tell me, prior to what we used to check? 12 months. So if the period of holding was less than equal to 12 months, So then it was a short term capital asset. I for indexation. Indexation available, not available? Not available. And if the period of holding was more than 12 months, so they used to be long term capital asset. Yes or no? Indexation was available or not available? Here also the indexation was not available. But there were two types of listed bonds or debentures. Two types of listed bonds or debentures. Indexation will be, see, long term capital asset. Indexation is usually not available. But if, here I am writing a note, if capital index bonds or sovereign gold bonds, they are long term capital asset. If they are long term capital asset, meaning their period of holding is more than 12 months, then there you used to get the indexation. Yes or no? Yes or no? So this is a situation prior to 23rd July. Prior to, okay. Now wait, on or after 23rd July? On or after? Period of holding for listed securities has changed or it is remaining same? Same. Earlier also for listed securities, listed bonds, listed debentures, listed shares, earlier also you used to check 12 months. Now also you are going to check 12 months. So if the period of holding is less than equal to, so they are still short term, no need to do any indexation. Yes or no? Now earlier, if the period of holding used to be more than 12 months, then there used to be any indexation? No. Right now also there is no indexation. But earlier you used to get the indexation for capital index bonds and sovereign gold bonds. But if they are transferred on or after 23rd July, now this indexation will also go away, because indexation benefit for all assets which are transferred on or after 23rd July is gone. But if the transfer happened prior to 23rd July, then you used to get indexation. Will you remember this? Hello sir. So now tell me, listed securities, listed bonds, listed debentures. Now what about unlisted? Unlisted bonds, unlisted debentures. Now here also they are transferred. When? Prior to 23rd July or on or after 23rd July. Yes or no? Now prior to 23rd July, when they used to get transferred, so ask yourself, listed security, is it a asset? Asset is a listed security. Asset is a unit of equity oriented mutual fund. Asset is a unit, no, debt oriented mutual fund. We are not talking about that anymore. We are talking only about. So bonds are, remember the name of those four assets. 12 months period of holding. What were the name of the assets? Listed? Is it a listed security? Unit of equity oriented mutual fund. Is it a unit of equity oriented mutual fund? Unit of UTI. Is it a unit of UTI? Number 4. Is it a zero coupon bond? Is it unlisted shares? Is it immovable property? It is any other asset. You used to check how many months? So if the period of holding was up to 36 months, then they become short-term capital asset and you did not get any indexation. But if their period of holding was more than 36 months, so they become long-term capital asset and still the indexation benefit was not available, because indexation benefit was available for only two types of bonds: capital index bonds and sovereign gold bonds, which were usually listed. So only those two bonds. Other than that, any listed bonds or debentures, or even the unlisted bonds or debentures, indexation benefit was not available, meaning you are not allowed to inflate the cost. You are not allowed to inflate the cost by including the inflation in their cost, because their value does not change over a period of time due to inflation. Inflation does not affect their value, but it definitely affects the value of capital index bonds, whose value is derived by inflation. It definitely affects the value of sovereign gold bonds, whose value is dependent on gold. Getting my point? So, for those two assets, if you are taking indexation benefit, then it is okay. But for all other bonds and debentures, there is no indexation. There is. So, even if it is listed or unlisted, no indexation. Yes or no, sir? Will you remember this much? Wait. Now wait. What if these bonds or debentures are transferred, unlisted bonds and unlisted debentures are transferred on or after? Transferred on or after? So for all the assets where the period of holding was more than 36, period of holding was 36 months. For all those assets, now the period of holding to be checked is? Now the period of holding to be checked is? So less than equal to 24 months. It will be short term. It will be indexation not available. And what if the period of holding is more than 24 months? It will be long term capital asset, and still the indexation will not be available because the transfer is done. Wait. On or after 23rd July, on or after, if the transfer of unlisted bonds is made, unlisted bonds or debenture, transfer is made, no need to do all these things. No need to do, because it is covered by, now covered by, now covered under section 50 AA. And what 50 AA says, you know? Ignore period of holding. No need to check the period of holding of these assets. No need to check the period of holding of these assets which are covered in 50 AA. The list had only two assets. Now this asset is also included. Yes or no? Now this asset is also included. Now they are saying that 50 AA says don't check period of holding. Calculate the capital gains without taking any indexation, and the resulting gain, indexation benefit will also not be available, and whatever gain or loss will arise will always and always be short term. 50 AA over. We don't want you to take the benefit of period of holding. Bloody, if you will see the period of holding, then you will come to us to fight that, see, the value is changing. Okay, we should get the indexation benefit. Inflation is affecting this and that. All the logics you are going to give. If we allow you to consider the asset as what? Long term, which depends on its period of holding. Bloody, if we'll ignore the period of holding only, you will not be able to call the asset as long term, because the period of holding has to be ignored. You will not be able to call the asset long term only. So you will not come to us to fight for indexation. Getting my point? With this logic, the section 50 AA came last time, and they included how many assets? Two assets. One, market linked debentures, and second, units of specified mutual fund. Usually their value changes. Usually their value changes. And if they were if based on their holding period, the assessee used to come to know that it is long term, then the assessee was asking for what? Indexation benefit. Since we are getting indexation for those assets, for those bonds whose value changes, so we should get the indexation for these also, because they are market linked. They are, or units of specified mutual fund, even their value keeps on changing. So you used to come to us to ask for what? Indexation. That give the indexation benefit. See, I am holding it for long term. I am holding it for, and every time there used to be a fight between you and the department. There used to be arguments. You used to say that I should get the indexation. Why? I am holding it for long term. And the value is also, see, keeps on changing. And usually for debt, the value does not change. Getting my point? But these are market linked. These are listed. That all types of arguments you used to give. But ultimately the underlying asset is debt. So if underlying asset is debt whose value does not change, hello, why do we allow you indexation for this? And value is changing because it is in the market, listed. So there will be definitely demand and supply, and because of that the value keeps on changing a little bit. That is not the reason for which we should give you indexation. So don't come to us to ask for indexation. Department used to say that. And there were many cases which the assessee filed to get that indexation and all. They wanted to settle this thing. Hence they came up with new section in the last year, 50 AA, where they included two assets. And this year, our madam, Mrs. Sita Raman, she said that it happens for these assets also, because the underlying asset is what? Debt. Underlying asset is what? So for this, if we are giving this logic, why not for these assets? Apply the same logic. Why? Because see, if these assets are treated as what? Long term. Usually you will get indexation, and if not indexation, what used to happen? The long term gain arising used to get taxed. Under section 112 at 20%. So what was the maximum tax the government would get? 20%. If they will be considered as long term. Understanding? But master stroke. Ignore the period of. Now whatever gain or loss will arise will always be, and any short term capital gain which is not covered by 111A, is taxable at normal rates, and normal rates can go up to 30% also. Getting my point? So one asset, market linked debentures. Second asset, units of specified mutual fund acquired, transferred, no, acquired on or after, and any unlisted bonds or debentures which are transferred on or after, any of these three assets will be covered by 50 AA, and it has overriding effect. In spite of anything contained under section which defines, meaning ignore the period of holding, capital gain arising on transfer of above three assets shall be treated as and will be taxable always at. We will not give you the chance to make this asset long term so that you ask about indexation or you pay tax at 20%. Getting my point? So that option is snatched. No period of holding to be checked, and resulting gain will always be taxable at normal rates. Resulting gain will be short term and will be taxable at. So how the computation of capital gain will happen? You will take full value of consideration on the transfer of these assets minus transfer expense, yes or no? There will be net consideration and minus what? Without any indexation, since period of holding is to be ignored, and the gain will be short term, cannot be, since the period of holding to be ignored, and such capital asset cannot be treated as long term. So always the resulting gain will be short term. Okay? Hello? And please pay attention, if this and this was listed, then they will be transferred through recognized stock exchange. They will be acquired through recognized stock exchange, they will be transferred through recognized stock exchange. So there is a possibility that for these two assets, you might have paid STT also. You might have paid. So no deduction in respect of STT while computing the capital gain. I have already told you this. Understood? Everyone? Now see, what is the meaning of market linked debentures? You have to read it. What is the meaning of units of specified mutual fund? That you are supposed to read. Okay? I have already explained this. Now the bonds and debentures, the table I have, entire chart I have given. Can you see this chart? Hello? See this chart today at home. It will give you the entire clarity about bonds and debentures. First of all, if the bonds and debentures they are transferred prior to, so what period of holding you used to check? Less than equal to 36 months. Short term and resulting into short term gain. Hello? No indexation resulting into short term gain, and the short term gain was taxable at what rate? Normal rates. If the period of holding was more than, it used to be, no indexation was available. No indexation was, but the long term gain used to be taxed under 112 at the rate of 20%. Getting my point? Now pay attention. Finance Act 2024 has an amendment which says that unlisted bonds or debentures transferred on or after will now be covered under section 50. Will you check the period of holding? No. It will always be treated as, and the gain will always be, and it will always be taxable at. So there is no chance then that the gain is now taxable under 112 as long term gain. Okay? Will you remember? Now let's come to this part. Listed bonds or debentures. And if the listed bonds or debentures are capital index bonds or sovereign gold bonds, if they are prior to, so period of holding less than equal to, they are short term gain will arise taxable at normal rates. And if they are transferred prior to 23rd July and their period of holding was more than 12 months, they will be treated as, and in this case the indexation benefit was available. Getting my point? And the resulting gain used to be charged under 112 at the rate of 20%. Getting my point? But wait. Now, if the capital index bonds or sovereign gold bonds are transferred on or after, period of holding you will check will remain same because they are listed, and for listed bonds and debentures there is no change in the period of holding. You have to check period of holding of 12 months. Earlier also you used to check 12 months. Now also you are going to check 12 months. Less than or equal to 12? No change. Can you see? And what if it was more than 12 months? It used to be treated as long term and you used to get indexation. But since the transfer is made on or after, so even if they are held as long term capital asset, now there will be no indexation benefit for capital index bonds as well as sovereign gold bonds. Yes or no? Now if the listed bonds are any other bonds or debentures which are transferred prior to or on or after, whenever you transfer, the period of holding you have to check. If you transfer prior to 23rd July, on or after 23rd July, this is not going to change. Less than equal to 12 months. They are short term, and the gain will be taxable at normal rate. Short term gain will be taxable at normal rates, and if held for more than 12 months, they will be. Earlier also you were not getting any indexation, now also you are not going to get any indexation, and the resulting gain, earlier also it was taxable under 112, now also it is taxable under 112. Yes or no? Will you remember this? Entire chart. So everywhere whatever effect has to be given for different types of bonds or debentures, I have covered in one chart. Okay. Now let's move on to the next part. 50B. 50 talks about capital gain arising in case of. Now pay attention. I'm going to write something. Which was the first asset? Which was the first section in special aspects? It was section 5050. A specific type of capital asset was covered over here. What capital asset was covered? Depreciable. Depreciable capital asset forming part of block in business or profession. Now for this type of capital asset, how the capital gain will be determined is given in section 50. So section 50 talks about a specific type of capital asset. And if this type of capital asset is transferred, this is a special type of capital asset. If this type of capital asset is transferred, how the capital gain will be computed? Yes or no? Now, do you remember the next section? Which was the next section? 50A. In section 50A also, a specific type of capital asset is given. Again, a depreciable capital asset on which depreciation is claimed on SLM basis under section 32(1)(1). Can you see? Again a specific type of asset they are talking. In the case of this asset, how the capital gain will be calculated. This entire discussion I have done in PGBP. Okay, no? Hello? Now tell me, after this we did one more section 50AA. Section 50AA. This section talks about capital asset. Only one capital asset or three types of capital asset? That capital asset can be market linked debentures, or it can be units of specified mutual fund acquired on or after 1st April 2023. And one more capital asset, unlisted bonds or debentures which are transferred, which are on or 23rd July 2024. In the case of this type of capital asset, how the capital gain will be computed? Ignore the period of holding, resulting gain will be short term, hello, and which will be taxable at normal rates. Understanding, no? Now let's come to the next. 50B also talks about a capital asset, and that capital asset is business undertaking. business undertaking or business unit, or you can say business division also. Now each asset, I'm not talking about the asset, now I'm talking about the entire business undertaking, which is treated as a capital asset. Now this business undertaking or unit is what? Transferred under the transaction of what? Slump sale. Which sale, sir? So slump sale is going on. In the transaction of slump sale, business undertaking is transferred. First of all, what is slump sale? As a going concern, transferring your entire business for a lump sum amount is known as slump sale. For example, I have one business, one factory. This factory will have many assets, plant and machinery, then land, then stock, and it will have many liabilities also. Yes or no? Asset side, full asset side, many assets are there. Full liability side, many liabilities are there, outside liabilities. Okay. Now this entire business having these many assets, these many liabilities, out of them single asset I am not transferring. No. This entire business which is run by me. See, I am the owner of the business, sitting on the chair of the owner. I will stand up and go away. You take the chair as owner. You fill this chair as owner. Become the owner of my business. It is a running business. Up till now, I was running. I will leave the chair of the owner. You occupy the chair of the owner and continue running this business. This is slump sale. But give me a lump sum amount. So for example, I am in the business of manufacturing air conditioners, and I am also in the business of manufacturing these projectors and computer equipments. So I have two manufacturing business. One, manufacturing of air conditioners, and two, manufacturing of projectors and other computer equipments. Now see, I see a growth in my second business because of AI, this and that. I see a growth. And this AC business, okay, it is not that much remunerative and it is also very time consuming. I don't like to do this business. I want to focus and channelize all my energy to my one business only. That does not mean that this air conditioner business, I want to shut it down. I don't want to shut it down, okay? But if somebody is interested in doing this business, no, I will hand over this business to that person, okay? So now, unit 1, business 1, and unit 2, business 2. So I am keeping my business 2 with myself, and I am asking in my circle that any one of you interested in doing a manufacturing business of air conditioners. So Santosh, he wants to start a new manufacturing business of AC. Instead of starting a new business, he'll get a running business. Yes or no? So I will ask him that, see Santosh, this entire running business I am giving you, take it as a going concern from me, yes or no, and continue this business if you want. Give me 50 crores for my entire business, lump sum amount. How much? 50 crores, lump sum amount. Yes or no? Now he will negotiate. No sir, 50 crores is too much. Let's sit on the table. Due diligence will happen. many other things will happen, and then we will negotiate, and renegotiated price was 45 crores. He also agreed to give. I also agreed to take. I took 45 crores for my entire business and I transferred that entire business to Santosh. Now, did I get 45 crores for transferring my business? In this business, many assets are also there. So in the course of sale of my business, the assets, the capital assets which are there in the business are also sold. So capital gain should arise. Capital gain should, but cannot be calculated. Why? Because in this 45 crores, how much I have taken for which capital asset, even I don't know, and even he does not know that in this entire 45 crores, how much he has given for which asset. So entire business, including the capital assets, liabilities, etc. of the business is transferred for a single consideration, and in that single consideration, individual values to assets and liabilities is not. Individual values of assets and liabilities is not given. That in this 45 crores, I am giving this much for land. In this 45 crores, I am taking this much for building, this much for this asset, this much. No. Individual values are not assigned to any asset or liability. Without assigning individual values to assets and liabilities for a lump sum consideration, if the business is transferred, that is slump sale. That is. Now, in this case, there will be a lot of problem to determine capital gain for each asset which is getting transferred along with the business undertaking. Along with the business undertaking, each asset which is getting transferred, for each asset, now there will be a huge difficulty to calculate what? Capital gain, because individual values are not assigned. So I don't know that for how much my land is transferred. FVC is not known. I don't know that for how much my building is transferred, because in the lump sum amount, I don't know that how much I have charged for building. So full value of consideration is not ascertainable. For all the assets, individual amount is not ascertainable. So the capital gain for each asset cannot be calculated separately. Hence, no capital gain to be taxed. No capital gain to be taxed. Just imagine, if nothing is done for this, I will never buy an asset on my individual name. I will start a business and always keep on buying all those assets on the name of my business. And who is going to come that whether I am actually doing that business or not? And now whenever I'll be interested in selling these assets, I'll not sell these assets individually by taking single consideration. I will transfer all the asset at one lump sum price, consolidated price, and say, let's see, in this price, no, I don't know that how much I have charged for which asset. There will be never any person who will be calculating capital gain and paying tax. There has to be some provision taking care of this thing. Hello, sir. So what they have done? They have come up with section. So what section 50B says? What section 50B says? That your entire business undertaking which you are transferring under slump sale for a lump sum consideration, that entire business, unit, division or undertaking is getting transferred by any means, whether you can sell it, you can exchange it, you can relinquish it, compulsory acquisition, whatever will happen, it will be treated as slump sale only, because transfer by any means. For a lump sum without assigning individual values to assets and liabilities in such transfer is known as slump sale. Now on this slump sale, capital gain will also arise and it will be taxable in the previous year in which the slump sale takes place. But to calculate the capital gain here, the entire business unit will now be treated as your, which is a combination of many assets and liabilities. This entire business will now be treated as your, and the capital gain for this asset will now be calculated under section 50B. Why? Because for this asset you are taking what? Will be full value of consideration. Will be, but wait, if the lump sum consideration is taken, fair market value of the consideration you are supposed to take, fair market value of the consideration, meaning the monetary as well as non-monetary consideration received or receivable on lump sum. That means the entire lump sum you are supposed to take. That is your FMV 2. And one more fair market value you will have to calculate. That is FMV of the capital asset transferred by way of slump sale as on the date of such. So in that slump sale transaction, whatever assets are getting transferred, you will have to consider the fair market value of those assets also, and you will have to consider the lump sum amount also. So fair market value of the assets, each asset which is getting transferred as a part of your business, for all those assets, what is the fair market value? That amount, or the total amount of your lump sum consideration, whichever is will be treated as your full value of consideration, and based on this the capital gain for this asset will be calculated. Yes or no? Now pay attention, what will be the cost of acquisition? Because see, you got the full value of consideration, you got the, first of all understand what is the asset. What is the asset? For this asset capital gain is calculated, yes or no? So for this asset, if the capital gain is calculated, what is the full value of consideration? FMV1, FMV2, whichever is, what is FMV1? Fair market value of the assets transferred under the slump sale transaction, yes or no? What is FMV2? Fair market value of the lump sum consideration, yes or no? A, B, whichever is higher, will be your full value of minus. So any expenses incurred to transfer your undertaking, yes or no? Transfer expenses, that you are going to reduce. So you will get net consideration. Now for this capital asset, full value of consideration is there. What will be the cost of acquisition? Now you will have to take the cost of the entire undertaking, because entire undertaking is your capital asset. So now you will have to determine the cost of this entire undertaking, which is nothing but its net worth. Nothing but its. How will you determine the net worth? You will have to check the, no. You will have to check the balance sheet. Balance sheet of my both business, no? This projector business as well as AC business. For both the business, balance sheet will be taken. Only the business which is getting transferred under slump sale. So the balance sheet of that business, yes or no? Immediately prior to, I will check the balance sheet of that business which is getting transferred under slump sale. And from that balance sheet, I will have to calculate the net worth. Now, there are two ways in which the net worth can be calculated. The way which you were saying is a liability side approach. Equity, capital, this, that, reserves and all. We have to follow asset side approach. We have to follow assets minus outside liability will result into net worth only. Remaining amount is net worth. Either you calculate the net worth directly by liability approach, capital as well as reserves, yes or no? Or you calculate assets minus outside liability, whatever will remain will be your net worth only. Yes or no? Wait. But here it will be calculated on asset side approach. You will take assets from the balance sheet. Assets from the, and you will reduce the outside liabilities. Now balance sheet as on the date which is immediately preceding to slump sale. Yes or no? So immediately preceding to slump sale, balance sheet you will take. From that balance sheet you will take assets. Now in that balance sheet, what assets you can see? You can see different types of assets. Some depreciable assets will be there. So the value of those assets in the balance sheet is known as book value. Is known as. So for depreciable asset, ignore the book value. The value appearing in the balance sheet will be taken or will not be taken. To calculate the cost of acquisition, which is nothing but net worth for the purpose of section 50B. You are calculating capital gain under 50B. So to calculate this capital gain under 50B, you have full value of consideration. What are you calculating now? Cost of acquisition. What is this cost of acquisition? To calculate the capital gain, the net worth. And to calculate this net worth, which is ultimately going to become your cost, will you take assets? Yes. Which assets? All the assets from the balance sheet. Out of those assets, some assets are depreciable assets. Some assets are. So value of those assets appearing in the balance sheet. Book value. You will ignore that value. You will. What value you will take? WDV of those assets as per the Income Tax Act. Then in the balance sheet you will have some assets whose entire cost is already claimed by you under the head PGBP, under section 35, 35AD, etc. Yes or no? What will you take? Will you take the balance sheet value of those assets? No, ignore. You will take nil, because its entire value is already allowed under the head PGBP. And if its book value is taken, meaning that amount you are going to claim again for the second time under the head capital gain as what? Cost. Getting my point? So for depreciable asset, remaining cost, which is not allowed in the form of depreciation. Getting my point? For those assets whose entire cost is allowed, no cost remains. So nil. Getting my point? Goodwill, you remember? Goodwill. If the goodwill is self-valued, have you incurred any amount to buy that goodwill? Or it is self-valued? An imaginary value of the goodwill is posted in the balance sheet. That amount you have not spent from your pocket. Have you spent that amount from your pocket? No. Then why are you taking that value? So if the goodwill is self-valued and the value is shown in the balance sheet, that is not a real expenditure. That is a notional amount which you have just posted in the balance sheet. Ignore that. Take nil. But what if the goodwill was acquired? Actually you have incurred money to get that goodwill. So whatever actual cost which you have incurred on that goodwill, take that. If the goodwill was acquired on or after 1st April 2020, because that is thrown out of PGBP head. And any goodwill which was acquired prior to 1st April 20, there was some actual cost. Out of that actual cost, some cost till 31st March 20, you have already claimed under the PGBP head in the form of depreciation. Reduce that, and the WDV remaining, even this balance cost is not allowed under the head PGBP. This goodwill is also thrown out. So for goodwill, can you take this amount? Yes. Can you take this amount? Yes. If the goodwill was acquired, and if the goodwill was self-valued, then ignore the book value, and what value you will take? Nil. Other assets, balance sheet value, no problem. Now tell me, try to imagine the asset side. Any depreciable asset, book value to be taken or ignored? Take the WDV for income tax purpose. Okay. Then try to visualize. In the balance sheet some assets are there. with some book value, but the entire cost of this asset is already claimed under the head PGBP, 3580, 35 and all. Yes or no? Hello? Then will you take this book value for these assets? Then what will you take? Nil. If, imagine the balance sheet, if in the balance sheet goodwill is given, it was not acquired, it was self-valued. Self-valued, and the amount is given for that goodwill in the balance sheet. What are you going to take? Nil. Ignore that book value. But in the balance sheet, if some goodwill is written, and that goodwill was acquired, ignore the book value. You have to take WDV as on 31st March 20 if that goodwill was acquired prior to 1st April 20, and if the goodwill was acquired on or after 1st April 20, then it's actual cost you are supposed to take. Yes or no? Any other asset appearing in the balance sheet like cash and bank balance, debtors, stocks, bills receivable, yes or no? Land, because land is not covered here also, and here also. So land will be covered in other assets. All the assets, all remaining assets you are going to take at, but remember, for the assets whose book value, balance sheet value you are taking, if in this balance sheet value you have done some revaluation, effect of that revaluation has to be eliminated. Meaning the actual cost of land was 10 lakhs. Actual cost of land was. So in the balance sheet, the land was recorded at 10 lakh. But immediately prior to slump sale, what you did? You did an upward revaluation of the land and you showed 50 lakh as the book value of the land. Meaning 40 lakhs extra. And that 40 lakhs you have credited to revaluation reserve. What you did? Land account debit 40 lakhs to revaluation reserve 40 lakhs. Now the value of the land in the land in the balance sheet will be how much? Will it be 10 lakh or it will become 50? So will you take 50 lakhs? Value of the land, book value of the land is 50. So you are supposed to take 50. But does it have any revaluation? Ignore the effect of revaluation, because the amount which you have shown extra by revaluing the asset upward, that amount you have not incurred as cost. Then why are you showing that amount? Bloody, if we'll allow you to take that amount, including revaluation, what will happen? Before slump sale, all your assets you will revalue. And if you will revalue them upwards. And in that case, the assets will be higher. Net worth will be higher, meaning the cost will be higher. There will be less capital gains. Getting my point? So ignore the effect of, if any, given for any asset, that is revaluation effect to be eliminated, adjusted for those assets where the book value has to be taken. But for other assets, you need not worry, because their book values are ignored. We are taking specific values. So by doing this, what will you have? You will have the value of assets. You will have the total value of assets. Out of that, you reduce book value of all the liabilities. What are you going to get? You are going to get net worth. And this net worth will be deemed to be your cost of acquisition. Understood? Yes or no? Did you get full value of consideration? Minus transfer expense. You got net consideration minus. Now you will get capital gain. But wait, the nature of gain will be short term if the asset is short term. The nature of gain will be long term if the asset is, what is your asset? What is your asset? Is it a listed security? Is it a unit of equity oriented mutual fund? Unit of UTI? Zero coupon bond? Is it unlisted shares? Is it immobile property? Different asset. How much period of holding? 36 months. If the transfer took place prior to And what if the transfer took place after, on or after 23rd July? Still you will check 36 months. Because the 36 months period of holding of this asset is not given in the definition of short-term capital asset. See, that 12 months, 24 months and 36 months. This period of holding was given in 242A in the definition of short-term capital asset. Yes or no? So wherever 36 months is there in 242A, that is changed and now that is made 24 months. Amendment is for that part. But if you talk about slump sale transaction, no, under section 50B only, specifically it is written that the period of holding of the business undertaking has to be checked 36 months. So like they did an amendment in 242A, hello, a simultaneous amendment should have been coming here also. But I don't know whether they have kept it deliberately or they have forgotten it. But this 36 months, there is no amendment under section 50B which says that the period of holding which is mentioned for the business undertaking under 50B, the period of holding of the business undertaking which is mentioned under section 50B will also be taken as 24 months. There is no amendment like that. Amendment is only for 242A. The period of holding of all capital assets used to be 36 months. Under section 242A will now be taken as 24 months. The amendment has come there. That period of holding for all capital asset is separate. And under section 50B, specifically here in this section itself they have written that for this business undertaking, check 36 months period of holding. Check. Yes or no? Because this is not any of those 4 assets. This is not any of those 2 assets. Yes or no? So usually you should be taking 36 months as you take for all the assets. So for this asset also, you will check 36 months. And this 36 months they have specifically mentioned also in 50B. But under section 50B, this 36 months written here will also become 24 months. There is no amendment like that. Getting my point? So you cannot apply that amendment in section 50B. 50B says this time limit, which is still unchanged. Please remember this. So if the slump sale takes place prior to, then period of holding, on or after, then period of holding. Would you like this? No. Why? Sir, you are here to teach, no? Teach. Don't sleep. Bloody, why are you here? Sleeping or studying? Then after some time again you will wake up. You will watch my face. Not interesting. After some time again you will wake up. Watch my face. Not interesting. Again you will sleep. What is this? You don't sleep at night or what? Or not getting that energy today, no? Not getting that energy. You want me to dance? Which is not possible. Sit straight. Sit straight. If you have some water, take a sip of water and 3 times. Actually works. Why? Simple logic. In the brain, no, carbon dioxide accumulates. that allows you to sleep. Oxygen goes, no, you become alert. Fact. Okay, try to do it. One more. Hold it now. Did you understand this? Tell me, how many months? Prior to 23rd July, slum soil, then also 36 months, on or after? Then also, but wait. Period of holding will start from. Period of holding of this business undertaking, you have to check 36 months. But it will start from date on which the undertaking commenced the business. It was set up. From that date only, it came into existence. So since when the assessee started holding this business undertaking as a capital asset? Since the date on which the undertaking came into existence. The date of setup. Yes or no? Till what date the assessee holding the business undertaking? Date of slum sale. So date on which the undertaking was set up, started, or till the date of slum sale. Till the date of, this is the period of holding. If 36 months are less, 36 months are short term, indexation will be available, not available? Not available. More than 36 months, long term, indexation will be available or not available? Sir, if the transfer taking place prior to 23rd July, then the indexation will not be available. Then also it was not available. Forget about now. Check the period of holding. How much? 36 months. Less than 36 months, short term. 36 months or more, whenever the transfer is taking place, prior to 23rd July, on or after 23rd July. Yes or no? Earlier also, even if it was long term, there was no indexation. Forget about right now. Right now there is no indexation. Earlier also, there was no indexation. Why? Reason is simple. What is the cost of acquisition? What is the cost of acquisition? Net worth, which you have calculated based on latest balance sheet. Balance sheet immediately preceding to date of slum sale. Yes or no? And based on the latest balance sheet, you have calculated the net worth which you are going to take as your cost. You are taking the cost of any prior year or recent cost only. And you think that will give you the indexation for this. What indexation you want? If the net worth would have been calculated for 10 years back, then that net worth has to be brought in today's terms. If the cost was incurred 10 years back, then that cost should have been brought to current period. Yes or no? By indexing or inflating. But this cost, this net worth was not incurred long back. We are calculating on the basis of latest balance sheet. So no need to give you any indexation benefit for this. No inflation will be added. So earlier also there was no indexation. The logic was this. Yes or no? But now forget about the indexation. Indexation is not available only. Will you remember? But resulting gain will be short term. If the period of holding is less than equal to 36 months. And if the period of holding is more than, then the resulting gain will be long term. No indexation. Yes or no? So the period of holding of business unit will start from date on which it was set up. It will end on the date of slum sale. Yes or no? Then less than equal to 36 months, more than 36 months, short term, long term, short term, no indexation. Even if it is long term, there will be no indexation. Whether the slum sale takes place prior to 23rd July or on or after 23rd July. Yes or no? Because 24 months period of holding is not available under section 50B, you are supposed to check only 36 months. Okay. Now whatever gain will be there, resulting gain shall be taxable as long-term gain and taxable under section 112. See, if this long-term gain is there, it will be taxable under section at the rate of, if the transfer took place prior to, and if the transfer took place on or after, then the gain will be taxable at 12.5%. Got it, sir? You won't believe, trust me. If a question on slum sale comes, it will be for minimum 8 to 10 marks in the exams. Minimum 8 mark question comes. And straight question. They will give you all these details in the question. You just have to arrange these details and get the answer. 2 questions are there in ICI study mat. 1 or 2 questions in ICI study mat on the slum sale concept. Today only go and solve that question. Today only go and solve that question. You will know that how easy this concept is. Getting my point? So this was your 50B. We'll continue from 50C after the break. Take a break, half an hour.